Having a look at the bond market now. ZB1 exclamation mark is the abbreviated symbol for the T-bond futures. We're having a look at the weekly time frame at the moment. This is the beginning of this year, and we've been predominantly bearish for the beginning of the year, from the beginning of the year going into April, which we've had a relief rally. My God, these braces are annoying me. I can't wait to get them taken out of my mouth, man. We've had a relief rally. The dealer range high was 120.20. We got a break, so it was 120.24. So 4 ticks above 120.20. Relative equal highs. All of this is regarded as relative equal highs now. Short-term retracement, gap, open, rally. This week, took buy stops. We failed to take 120.20, which was the target from last week. And we haven't taken sell side out. Now, I do believe that if the US 10Y, bearing in mind there is a inverse correlation between the yields and the bonds, right? If we were to see 4.249 buy stops taken out, and we're targeting 4.282 to 4.288, then 120.20 is going to be an area which, if we break, there's going to be significant volatility in this area, to a point where we could even run up into 122.23, 13, sorry. Because look how clean these highs are, guys. Look how clean these highs are. We took stops out, right, on a Monday. Bear in mind, sorry, this is a weekly time frame, so this is 2 weeks back. 2 weeks back, we opened lower than the low of the prior week candle. We spiked into 116.16, which is the lows to the highs, Dina range, discount, premium. Traded into a discount, rallied into a premium, took buy stops, rejected, ran down into a discount one more time, but we closed, because remember, candle bodies tells us the story. Wicks causes the damage, and the damage was done when this candle, once upon a time, was black. Well, it will be red in your case, so you can obviously change the color of each candle. If you want it black, if you want it purple, if you want it blue, if you want it pink, it's up to you. My color scheme is green to the upside and black to the downside. So in my case, once upon a time, this candle was fully black to the downside, trading right there below equilibrium. So a lot of people right then were thinking, you know what, I want to place my stops there and there in order to capture the shorts all the way down to the next point of quote support, which would have been at 114.11. We never got that, and we wicked, and then we rallied to the upside, closing inside of this prior weekly candle. Next week came along, took buy stops out, but we still managed to close inside of this 24th of June candle. So a lot of trading has happened in this area here, but this 120.20 region or 120.24 region is a very important region, which once taken out, we could get a lot of volatility, I mean, I'm not even gonna shy away from having a look at this sell side imbalance, buy side inefficiency. I won't even lie to you guys, like, we could even get a run up into this area there. So I'm actually gonna, you know what, for the time being, I'll leave this where it is, but I'll keep it in mind for sure. So 120.20 is the next point of interest, but I'm also looking at, so the relative equal highs, which is at 120.20 to 120.24, relative equal highs. But then if you get that break, then we'll have a look at 122.13. I would like to see how Sunday open going into Monday. I'd like to see the price action going into next week, because what you can see here on the daily time frame, Obviously, this is the point of interest that we're looking at, 120.20. I was looking for longs last week. Now, if you placed any longs from last week going into this week, and your goal was to take profit at 120.20, but you trailed your stop loss, so let's say you attacked these highs, but you wanted to place your longs from here, then on the Monday we spiked, and I believe Monday would have been the only opportunity for you to get inside. Remember, I don't trade the bond market. I only use this as some form of a barometer for all of the other markets, and especially ESU, which is the abbreviated contract for S&P 500. So Monday would have been the only opportunity to get into the market before looking at taking profit at the next point. So the next pretty much swing high, which would have been the Thursday, the 11th of July candle, which would have been at 120.11. Thursday, Friday, we sold off, and I'll be honest with you, if we don't get that break that I mentioned there, which is at 4.249, 118.01 sell side liquidity, it's going to be in danger. But I do believe that 120.20, it just looks too clean. 120.20 to 120.24, it's too clean. It's too clean, guys. So I'd like to see how this one plays out. I'm looking for longs going into next week. 120.20. 120.20. Buy stops has not been taken. We just have a short-term relief to the downside. Filled the gap, and we could rally back up to the upside. It's not a big deal, guys. You know what I'm saying? So we'll see how that plays out, and I'm very interested to see how this one goes. I'll give you guys a quick preview of the hourly time frame. This is what has happened for this week. Everything has already been uploaded into the Discord, and you've got the lows for the week, the highs for the week, previous buy stops taken, shift in market structure right there, order block, respect, sell off. Matrix, something I learned from a past mentor. So I flip the charts. What does it look like price is going to do? Well, you've got these highs here, all right? On 11812. I'm actually going to leave it like this, I'll be honest. So when you flip the charts upside down, right? Sell stops, which is actually buy stops, has been taken. You've got the low, high. So it's like a 3-pin pattern. Short term, intermediate, short term, run, take these highs. So what we could actually do, right, is we could run. I'd like to see something along the lines of, we run, take these highs out, right, fail at 11916, and then take 120.20 out. So I thought, let me just use that. I haven't used that in some time. Oh, that was fun. That is the hourly time frame, and I'm gonna wrap this one up, guys.